Alright, let's dive into something that's been bubbling under the surface lately, the fascinating connection between falling oil prices and the gold rally. Now, I know what you're thinking, oil and gold? How do those even relate? But stick with me, because this isn't just about numbers and charts, it's about the bigger picture of global economics and investor psychology. Here's the hook: lower oil prices are actually lending support to the gold rally, and it's a dynamic that's both counterintuitive and incredibly revealing. So, let's start with oil. Oil prices have been on a roller coaster lately, thanks to renewed U.S. Iran diplomacy and the potential reopening of the Strait of Hormuz. Personally, I think this is a huge deal, not just for oil markets, but for global stability. The Strait of Hormuz is a critical choke point for oil shipments, and any easing of tensions there immediately calms supply fears. But here's the kicker: while oil prices have snapped back recently, they're still way below their July peak. What makes this really interesting is that it's not just geopolitics driving this, it's also about demand destruction. The International Energy Agency, IEA, has slashed its global oil demand forecast for 2026 by 1.1 million barrels per day. Why? Because high oil prices have been crushing industrial activity, especially in Asia. From my perspective, this is a classic example of how markets can self-correct. High prices lead to lower demand, which then pushes prices down. Now, let's pivot to gold. Gold is often seen as a safe haven asset, but it's also deeply tied to inflation and interest rates. Here's where things get really fascinating: falling oil prices are actually helping gold. How? Well, when oil prices drop, manufacturing and transportation costs go down, which eases inflationary pressures. And when inflation fears cool, central banks are less likely to hike interest rates aggressively. This is huge for gold because, as a non-yielding asset, it becomes more attractive when the opportunity cost of holding it decreases. In my opinion, this is one of those moments where the interconnectedness of markets really shines. A drop in oil prices isn't just good for drivers, it's a tailwind for gold investors. But there's another layer to this story that I find absolutely fascinating: the role of the U.S. dollar. A weaker dollar makes gold cheaper for foreign buyers, and right now, the dollar is softening as energy markets stabilize. What many people don't realize is that central banks, especially in Asia, have been on a gold buying spree. In Q2 2026 alone, they added a record 289 metric tons of gold to their reserves. Why? Because they're diversifying away from the dollar and sovereign debt. If you take a step back and think about it, this is a massive vote of confidence in gold as a long-term store of value. It's not just individual investors who are bullish, it's entire nations. Now, let's talk about the elephant in the room: the Federal Reserve. With weaker than expected U.S. macroeconomic data, the odds of an aggressive rate hike in September have dropped. This is a big deal for gold because higher interest rates typically weigh on its price. But here's where it gets really interesting: even with all this support, gold isn't immediately surging to new all-time highs. Florian Grums, a gold analyst I respect, believes gold could hit $4,500 this summer but doesn't expect a new record this year. What this really suggests is that while the outlook is bullish, it's not euphoric. And that's actually a healthy sign. It means there's still room for growth without the risk of a bubble. So, what's the bigger takeaway here? In my opinion, this isn't just about oil prices or gold rallies, it's about the delicate balance of global markets. Falling oil prices are easing inflation, supporting gold, and even influencing central bank policies. It's a reminder that everything is connected, from the Strait of Hormuz to the Fed's interest rate decisions. One thing that immediately stands out is how quickly these dynamics can shift. Just a few months ago, we were talking about oil hitting $100 a barrel and gold struggling under high yields. Now, the narrative has flipped. This raises a deeper question: how sustainable is this rally? And what happens if oil prices rebound or inflation heats up again? As we wrap up, I want to leave you with this thought: markets are always telling a story, but it's up to us to read between the lines. Lower oil prices supporting the gold rally isn't just a headline, it's a window into the broader economic landscape. Personally, I think this is a moment to watch closely, not just for traders but for anyone trying to understand where the global economy is headed. So, what do you think? Is this gold rally here to stay, or is it just a blip in the bigger picture? Let me know in the comments below. I'd love to hear your take.